Hi, I'm Barkley Roper with Tiger Capital Management, a registered investment advisor in the state of Idaho, bringing you your weekly trend update and helping you stay on the right side of the market. Last week, we talked about the compound returns over different periods of time using two different strategies, a buy and hold strategy and a long-term trend following strategy. And we looked at the different compound returns over a 20, 10, 3, and 6-year period. And over that same period of time, I posed the question to the viewer at the end that we're going to talk about today is, did we take on more risk in order to get a higher return? Because if you remember, the 20-year compound return using the buy and hold strategy was approximately 6.47% versus using the timing or long-term trend following strategy was approximately 9.3%. And so when we look on a risk-reward scale, typically the more risk we take, the higher the reward, and the less risk we take, the lower the reward. And so my question was, did we take on more risk in order to get 9.3%? So that's what we're going to talk about today. One of the typical measurements for risk in investing is a measurement called standard deviation. And that standard deviation is measuring how far actual returns are from the average return. Or in other words, just to make this very simple, the lower the standard deviation, the less risk we're taking. The higher the standard deviation number, the more risk we're taking. And so we're going to just look at that data real quick. So using the S&P 500 is what we used last week to look at the compound returns. And although we can't invest directly in the S&P 500 index, we're using an ETF or a mutual fund, in this case an ETF called the ticker symbol SPY, and which is the investment vehicle over the last 20 years. And the compound return of the buy and hold strategy, as I already mentioned, was 6.47%, with a standard deviation of 15.11%. Okay, while the trend following strategies compound return was 9.3% with a standard deviation of 10.43%. And so we can see that although past performance is no guarantee of future results, that the standard deviation was less, therefore the risk was less in the long-term trend following strategy versus the buy and hold of the S&P 500 over the last 20 years. So the trend following strategy had a 43% higher return than the buy and hold strategy with 31% less volatility. So that answers our question from last week if the volatility that we took was greater than the buy and hold strategy versus the timing strategy. And the answer was no, we actually took less volatility or less risk using the long-term trend following strategy. So great. Well, let's go ahead and turn to the charts and look at our trend update for this week. So first here on the chart we have U.S. stocks, and we can see that U.S. stocks are still, they're right at their 50-day moving average line and well above their 200-day moving average line. And so these U.S. stocks represented by the S&P 500 are in a confirmed uptrend. Foreign stocks also have bounced off their 200-day moving average, moved above their 50-day moving average, and are still in a confirmed uptrend. Real estate investment trusts. Right here, we have the price. Last week, they were right here at this support level that we've talked about multiple times. And real estate, as of right now, is still just barely above that. We can see that the 50-day moving average crossed below the 200-day moving average, which gives us a signal that we could be in a confirmed downtrend. But because this was so drastic and happened so quickly, wanted to look for a support area, and we're right there at that support. We're still in a confirmed uptrend as of right now. It could change at any time. One thing I can point out in this situation is that if you've been in real estate over the last 4 years that it's been in a confirmed uptrend, you still have quite a big gain in real estate. And so you'd still want to hold. If you entered in right at the very high a few months ago and the prices come down, you have lost quite a bit and you would have wanted to exit probably a lot sooner. If maybe you got in at somewhere down here where we're still above that price, but you'd want to probably exit and just have a basically break even at that point. And so when investing, we have to take into consideration the time frame that you have been invested when we change from an uptrend to a downtrend and vice versa. Going on to commodities right here. Commodities have rebounded somewhat. They popped up above their 200-day moving average, are still below. 50-day moving average is still below the 200-day moving average. And so as of right now, we're going to say commodities are still in a confirmed downtrend. And bonds. Bonds also are the price right here is well below the 50-day moving average. Price is also well below the 200-day moving average. So as of today, bonds are also in a long-term downtrend. So we're just going to go through that one more time real quickly. U.S. stocks are in a confirmed uptrend. Foreign stocks are in a confirmed uptrend. Real estate, as of right now, we'll say confirmed uptrend. Commodities are in a confirmed downtrend. And bonds are in a confirmed downtrend also. Well, great. Well, that wraps it up for today. I'm Barclay Roper, Tiger Capital Management, bringing you your weekly trend update. If you have any questions or comments, please feel free to give me a call or email me. Thanks, and we'll see you next week.